Welcome back to the Taxtron YouTube channel. In today's tutorial, we are diving into a topic that might sound complicated but is actually crucial if you are thinking about saving on taxes. The Qualified Small Business Corporation or QSBC. If you own shares in a business, you will want to stick around because this could mean significant tax savings for you. What is a QSBC? So, what exactly qualifies as a QSBC? In simple terms, QSBC shares allow you to access the Lifetime Capital Gains Exemption, LCGE, which can reduce or even eliminate the taxes you would pay on the capital gain when you sell those shares. But to qualify, a corporation and its shares need to meet certain conditions. Condition 1, Small Business Corporation. There are three key conditions a share of a corporation must meet to be considered QSBC shares, which will make you eligible for that capital gains deduction. First, at the time of sale, the share must be part of a small business corporation, meaning 90% or more of the company's assets must be used in an active business primarily in Canada. This could include assets like real estate, equipment, or even intellectual property. Condition 2, Holding period for shares. Second, you or a related party, such as your spouse, common law partner, or a partnership of which you are a member, must have owned the shares for at least 24 months. Throughout this time, the corporation must have been a Canadian-controlled private corporation, CCPC, and at least 50% of its assets must have been used in an active business. Condition 3, Ownership exclusivity. The shares must not have been owned by anyone other than you, your spouse, or a related party throughout the 24 months before the sale. QSBC 90% Rule explanation. Alright, now let's talk about what is QSBC 90% Rule. When you are looking to sell shares of a small business and want to qualify for the Lifetime Capital Gains Exemption under QSBC, one of the main requirements is that your corporation must meet the 90% rule. But what does that mean? Basically, at the time of sale, 90% or more of the corporation's assets need to be used primarily in an active business carried on in Canada. That includes things like your office space, equipment, inventory, and any other business-related assets you use to generate income. But if your corporation is holding too many passive investments like stocks or extra real estate that is not used in your operations, you might not meet the rule. Example of the QSBC 90% rule. Let's go through a quick example to make this clearer. Imagine you own a small manufacturing business. You have assets like machines, tools, and raw materials that are all used in the daily operations of the company. The building where your factory is located is also considered an active business asset. Together, these assets make up 90% of your corporation's total assets, which means you would meet the 90% rule. But, let's say your corporation owns a separate building that you rent out to another company or some stocks you are holding for investment purposes. These would be considered passive investments. If those passive investments start to make up more than 10% of your corporation's total assets, your business may not meet the 90% rule. CRA's reason for the 90% rule. Why does the CRA care so much about this 90% rule? Well, the purpose of this rule is to make sure that the tax benefits from the Lifetime Capital Gains Exemption go to true small businesses actively operating in Canada, not corporations holding too many passive investments. Special rules and exceptions. Now, apart from the 90% rule, there are some special situations. For example, if the corporation issued shares to you or a related party after June 13, 1988, the CRA generally considers that an unrelated person owned the shares just before they were issued. To meet the 24-month holding requirement, the shares must have only been owned by you, a related party, or a partnership you were part of after they were issued. But there are exceptions to this rule if the shares were issued as payment for other shares, as part of a stock dividend, or when certain assets used in the business were transferred to the corporation in exchange for shares. These are important nuances to understand if you're planning to sell shares. Example of special rules and exceptions. Let's have a simplified example of the special rules and exceptions for QSBC shares. Imagine you own a bakery, and you decided to incorporate it a few years ago. You transferred most of the bakery's assets, like ovens, equipment, and supplies, into the corporation in exchange for shares. This transfer allowed you to become a shareholder of the corporation. According to the CRA's special rules, since you received shares in exchange for your bakery assets, the 24-month holding period for QSBC shares begins right after you got those shares. Even though the CRA considers that an unrelated person owned the shares before they were issued to you, you don't have to worry about that in this case. You still qualify for the holding period requirement because you transferred active business assets into the corporation. Exception rule example. Let's say the bakery needed to raise more funds, and instead of selling the bakery's shares directly, the corporation issued new shares to you as a stock dividend, a common way companies reward shareholders. Since the shares were issued as part of a stock dividend, the usual rules do not apply. You can still meet the 24-month holding period rule, even though these shares were just issued to you. Capital gains deduction. So here comes the exciting part, the capital gains deduction. If you sell qualified QSBC shares and realize a capital gain, you could claim the LCGE. For the 2024 tax year, this could be up to $1.25 million. That means if your gain falls within this limit, you won't pay any tax on that amount. Conclusion: check your QSBC status. So, wondering if your shares qualify? Taxtron can help you with that. Drop your questions in the comments below and don't forget to subscribe for more tax-saving tips. You won't want to miss our upcoming content on more ways to reduce your tax bill. Thanks for watching.